How do you manage 2008 type markets without experiencing 2008 type losses? And no, I'm not talking about an annuity. Find out how to do it in this episode. Many people come to us concerned about going through another 2008 type market. What happened in 2008? Why was it called a bear market? Well, let me walk you through some of the numbers. From October 9th, 2007 until March of 2009, the market lost $11 trillion in 17 months. The S&P 500 index lost 57%. What does this mean for the average investor? The average investor lost 56.78%. What does that mean to a $500,000 portfolio? That means it went down to $216,000. That's a big loss during retirement. So how do you avoid this? Radon's going to talk to you about how we help our clients avoid a 2008 type market.
So Murs just walked you through some pretty devastating numbers, especially if you are close to or already in retirement. Many of our clients do not want to be exposed to this type of market. So what I want to do is walk you through how this can look if we have a plan to navigate such a market. So let's review. If you have a portfolio that has a major decline in it, like we had in 2007 into 2008, which is a 50% decline, how would it affect you? Well, if you had $1 million at the top of the market in October, when you get down to the bottom of the market in March of 2009, that portfolio has fell to $500,000. Now, if you say, well, I lost 50%, I want to make 50%, am I back to a break even? No. I have to earn 100% to get back to a break even. A 50% return on $500,000 only has me back to $750,000. In our actual portfolio that we managed through that 2007, 2008 downturn, we actually lost 3%. Now, let's talk about this for just a moment. What we are not trying to say to people is that we have some magic method that we can avoid big downturns, and yet you're going to make everything on the upside. So I'll tell you the real numbers. In 2009, the stock market made 23%. In our 100% portfolio, of 100% stock portfolio, we only made 15. So we are not trying to tell you we're going to make everything on the upside and avoid the down. There's not anyone who can do such a thing. What we can do though is help avoid the major declines and yet keep your portfolio intact. By the way, if somebody made 23% in 2009 after losing 50, and let's say we did only 10%, who has more money? Obviously our client does, because we've actually saved so much of their portfolio or principal. Now, how do we do that? That's the big question. Well, the market works in what we call an S-curve. That means it's going up and down over time. If we look at it long enough, the market will go up. What we're trying to do though is avoid those big negatives and yet still get potential growth on the upside. Now again, what we're not telling you is that we have some magical way that we're going to buy there at the bottom and then we're going to sell it there at the top. What we do is we track price movement, price demand. And when we see a demand, we want to enter into that particular place of the market. So you'll see here where I've put the mark is we're not at the bottom, we actually have identified demand. Now what we know is this demand's not going to stay in play forever. So what we want to do is to protect whenever it starts to decline. So we're going to have a sell-side discipline that will get our clients out of trouble before they have a major decline. So if you're looking at this and you're thinking, well, this just sounds like it's too easy. Well, it's not easy. We have a rather large staff of people that help us monitor all this price movement. And we actually are very transparent. We go through this every single month with our clients. We talk to them about what we've bought, what we've sold. By the way, this is not day trading. Things don't move that quick. But we lay this out for all of our clients or anyone looking at us. So if you think to yourself, I'd like to see what you guys are doing on a monthly basis, we would gladly invite you to our monthly conference call. Our goal is, as always, is that you're able to navigate the markets, make a decent rate of return, and have a peace of mind retirement plan. Thank you for watching the video. I hope you found it beneficial. But if you still have questions as you plan for and live through retirement, I have put together an extensive kit to answer some of the most pressing questions as you plan for retirement. Just click the link below or give the office a call and we'll send the kit out right away.